would say that whatever the market has embedded in its valuation, whatever it's pricing in, is probably not going to come to fruition. But look, I was saying that before the election. I mean, before the election, you had like a 40 basis point equity risk premium, and now we're down to like 10 basis points. So we've gone from an egregious equity market price bubble to something that is more like flying over the cuckoo's nest. So firstly, congratulations on your portfolio. So your heart was telling you one thing and your wallet was telling you the other thing. So I would say that you were obviously perfectly hedged. But the question is, what is the market really pricing in here? And there's no doubt that there's a lot of things that Donald Trump can do on his own through executive order, and more deregulation, clearly a positive. You could point to the financials were the one sector that was really ripping from the outset. But, if the market is pricing in massive tax cuts, and of course we also had the visceral reaction of the bond market to, visions of an $8 trillion incremental debt balloon over the next 4 years, I think both of those have question marks in front of them. And I think that what nobody's talking about is the wide divide between what happened top ballot and what happened down ballot. And the one thing that we know is that when Trump won in November 2016, and even though he didn't win the popular vote like he did this time, this was not as much pro-Trump as people think. And I'm not even convinced it's actually a vote for Trump's policies. So what happened is that the market believes it's going to be one party rule, ruled by this pro-business party called the Republicans. And so what everybody did at the outset was take out the 2016 to 2018 playbook where equities ripped and bonds sold off until we got the split government and the midterms in 2018. Interestingly enough, the peak in treasury yields in 2018 happened in the November midterm. But the House is not the Senate. The House is a fractious group, and it's replete with fiscal conservatives on both sides of the aisle, including 38 Freedom Caucus members and the Republicans. So people that think, so you're asking me, do I think the market is wrong? I think the market is way premature in expecting that we're going to be seeing, at least when it comes to fiscal policy, the tax cuts that were being promoted during the campaign. I think that that is probably not going to happen. We're going to have more deficit spending. There's no question about that. The big question is, what's the amount going to be? And what's the overall impact on the economy and inflation going to be? This is basically, as I said, investors broadly speaking took out the 2016 to 2018 playbook. And the playbook was dump your bonds and buy stocks. And that was the initial reaction. I mean, when you're taking a look at the massive run-up in yields, and it wasn't just coming on the day of the election and the day after the election. This was starting once the market betting polls started showing Trump in the lead in early October. That's when bond yields really started to ratchet up. And of course, the run-up in yields just accelerated in the immediate aftermath of the election. But the bond market did, in a matter of a month, what it took 5 months to do, coming off the November 2016 election. And the stock market, 2,000 points in the Dow in a 2-day span, just is head spinning. Even that took, about 3 months to accomplish coming off the 2016 election. You priced in a whole lot in a short period of time because what people did, it's always a classic case. The markets shoot first and ask questions later. So Trumpflation, I guess, is the operative word. Reflation, buy stocks, sell bonds, and that was the initial knee-jerk reaction. I think that what unnerved the bond market is concerns that Trump's policies are going to lead to higher inflation. And I would push back hard on that because the one thing we do know with a 4-year sample size from 2016 to 2020, and even if you end that sample size to January 2020 before COVID, bond yields didn't really go up during his tenure, and inflation actually was stable to lower during his tenure. And that was with building an immigrant wall around labor. That was with tariffs being imposed. Nothing like he's talking about now, but I don't think that's going to happen anyway. To me, that's a negotiating tactic, and the stock market's looking at a renewed deregulation wave, and that's probably going to happen. I have no beef about that. But where the rubber meets the road is the view that he's going to once again slice top marginal corporate tax rates. And I don't think that's going to happen either. So, we went into this. The difference this time around, looking at the stock market, is that nobody expected Trump to win in November 2016. Trump himself didn't think he was going to win, which is why it took him so long to fill his cabinet positions. Even he was surprised.
Right.
And the market was sort of in the doldrums. I mean, we came off of Brexit, and then we came into a situation where Hillary Clinton was well up in the polls, which we know now that we can't trust that much. But the Trump victory in 2016 and the clean sweep came as a big surprise. This time around, it shouldn't have been that big of a surprise, yet more of a market reaction than even what we had coming out of November 2016. But once again, it's basically a market that is being fueled by speculation. There's speculation about what the total available market is going to be ultimately with AI. All sorts of speculation now about Trump policies. And you're right, I guess you could say that the stock market is priced in the most pro-growth parts of his policies and not some of the other ones, like his tariffs and his deportation. That much is true. They're just looking at, if he slices the top marginal rate to 15% from 21, well, what's that going to do to the earnings profile? And you got to buy stock. And that's the initial reaction. The other part of this is that when we went into the November 2016 election, where was the forward PE multiple? It was 17. It's 22 today. Where was the equity risk premium when he got elected in 2016? It was 400 basis points. It's like 30 or 40 right now. So it's a totally different ballgame. The level of the excessive valuation in the stock market is in a completely different orbit now than it was back then. So in answer to your question, no, I think that the market was really expensive going into the election. And now, a couple of days later, it's stupid expensive. I think that he would definitely need to have congressional approval. I mean, the Federal Reserve Act is a congressional act. The president, like how he appoints judges, does appoint the Fed chairman, but the Senate has to confirm it. And so I think that there's a lot of bluster here. I don't think that he's going to be able to replace Powell, and Powell made that very clear at a press conference. I think that what Donald Trump will probably end up doing is using the bully pulpit and his X account to try and pressure the Fed. We saw him do that in the past, but actually interfering directly, creating the shadow Fed or having his own personal Fed chairman rivaling the actual Fed chairman, I think that's just pure fantasy. The reason he won't do it is because it's going to work against his goals of maintaining financial market stability. That would be a policy prescription of triggering instability. And what we know about financial market instability is that's what leads to recessions. So I'm going to assume that there's a certain degree of rationality and that all the bluster during the campaign is not going to live to fruition. And that includes what he wants to do about the Federal Reserve. I do believe that he will be able to get a resolution to Russia-Ukraine. And of course, maybe this is an instance where his relationship with Putin might help foster that. And I don't think any of the two parties are going to be very happy with the resolution, but probably Zelensky is going to be a lot less happy. So there will be territorial concessions, but I do believe that that is a strong possibility. When you're talking about Israel, it's not just Hamas, but it's Hezbollah. You can argue the Houthis, and all lines go back to Tehran. So it's really more about Iran than it is necessarily about Hezbollah and Hamas, which are proxies of Iran. So my comment there is I do believe, compared to Harris, that he's going to give Netanyahu, I don't think that he's going to expect that the conflict with Hamas, for example, is going to end that quickly until Hamas surrenders, which maybe that never happens. I think he'll first settle what's easier, which is Ukraine, Russia. And in terms of China, I don't think Xi is going to be doing anything to get Trump rattled. That's the thing about Trump, is he's not a pacifist, but he's not from the military industrial complex. He's not really a warmonger, but people are scared of him. Nixon was not a warmonger. People were scared of him. He ended the Vietnam War, and the next thing you know, establishes relations with China, and people were scared in 1980. The big knock against Ronald Reagan running against Carter was that he's going to start World War III. You certainly remember that, and he's labeling the Soviet Union the evil empire, and the next thing you know, several years later, we have Perestroika. Well, you couldn't have predicted that in 1980, but people were scared of Nixon, and people were scared of Reagan. And I think it's probably a good thing for the rest of the world to be scared of the President of the United States. And so I think that there's a reason why, even though his White House was chaotic, as you full well would know, but who cares about that when in those 4 years the world was relatively more trouble-free, that's for sure, than it's been over the course of the past 4 years. To me, what's most important is how he deals with Iran. Iran is the greatest threat. China, could you argue China is an economic threat any longer as they continuously deal with their property sector deflation? They're in a structural growth slowdown. This is not the China of 10 or 20 years ago. So I see that as less of a threat, and China is not going to do anything with Taiwan, certainly not with Donald Trump in power. To me, the most important geopolitical risk is what happens with Iran. And the one thing we know about Trump is that he was a lot harder on Iran and the sanctions and so on and so forth. And my hope is that he realizes that this war in the Middle East is just broader than just Gaza and the West Bank and Hezbollah and Lebanon, but it's really about Iran and Islamic Jihad and extreme fundamentalism. So to me, that's going to be the most important geopolitical hot potato that he's going to have to handle. All roads lead to Tehran in the next 4 years from that, say, geopolitical aspect. I think that the safe havens will be gold. I think your Bitcoin probably does well. I'm not a big advocate of Bitcoin because I don't have ice in my veins. I look at Bitcoin as gold with 20 times the volatility. So you do have to have ice in your veins. But I do think that hard assets, you can argue commodities in general, they're screening very well, by the way, in our research work. So commodities, gold, I think that the elephant in the room is what I talked about before. I felt sorry for whoever won the White House. And I'll tell you why. Because Donald Trump is walking into a real landmine here with the equity market. That nobody's talking about the complacency, the view that we're in a perennial no landing, soft landing in the economy, that there will never be a bear market again. That sends shivers down my spine. I mean, I cannot believe everybody is all in on the same trade, and the amount of risk on household balance sheets in the United States has never been this acute before. But this equity bubble is going to burst, and I don't know when it's going to happen or what the catalyst is going to be. This equity bubble is going to burst, and then what happens, as always happens, is that the analysts and the strategists and the economists then apply a narrative to the price action. We don't know the catalyst. Usually the catalyst is just that the bubble becomes exhausted. And we know that bull markets are escalators going up and bear markets are elevators going down, but you see everybody is all in at the same time. And that has me really worried. I mean, over half the market is now passive index investing. When John Bogle unveiled 1976, he said this market will never get above 20% of the market cap. It's now over 50%. People don't even know what they own. So I'm very nervous. And so at these multiples, whether you look at price to earnings, price to sales, price to book, the CAPE multiple, the Buffett indicator, the fact that portfolio managers are below 2% cash ratio, households 70% exposure to equities, 9% exposure on the balance sheet to bonds. But who cares about bonds? You're going to go to the cocktail party. Your choice can talk about NVIDIA's latest orders numbers, or you go to the cocktail party and you talk about what a great 10-year auction there was today. That's not very sexy. But I'd say that I like bonds at these levels. So I'd say bonds, gold, commodities, and I don't think you have to do much more than that for your, quote, safe haven.